Chapter 9, we're going to look at financial statement analysis. So we'll look at some basic analytical procedures. So the first one we're going to look at is horizontal analysis. This is looking at increases or decreases in related items in comparable financial statements. So a better way to look at that is if we look at the example Exhibit 1, we see the Mooney Company, we see the balance sheet ended December 31st, 2012 and December 31st, 2011. What we're looking at is the change from 2011 to 2012. So what we see is that if we look under current assets, in 2011 it was $533,000, 2012 it was $550,000, so there was a $17,000 increase, which is 3.2%. So it's horizontal analysis. We're looking at it sideways. We're comparing December 2011, December 31st, 2012, and then we're comparing the balance sheet to see what changed. And that's horizontal analysis. Vertical analysis is we're showing the relationship to a total within a single financial statement. So if we look at the balance sheet, let's start with December 31st, 2012. So we see current assets $550,000. That is what we're looking at, is what percentage of assets are current assets. So if we take the $550,000 current assets, divide that into total assets, which is $1,139,500, we see that current assets are 48.3% of total assets. Then we do the same thing with long-term investments, property, plant, and equipment, and intangible assets to see what percentage they are of the total assets. And then we do the same thing for 2011. So a couple things you can see is that if we look from 2011 to 2012, current assets are a bigger percentage of our total assets. And you can see that long-term investments become a smaller part of our total assets. So maybe some long-term investments, we sold them off. Who knows? But that's the type of analysis we can do. So one thing you might be able to infer from this is that we sold some long-term investments to decrease our long-term investments. You see our current assets went up. Maybe the current asset cash came from selling the long-term investments. So that's what vertical analysis is. So what we're trying to do with both horizontal and vertical analysis is to identify trends. So remember, horizontal analysis, we looked at what changed from 2011 to 2012. In vertical analysis, we looked at the, say, current assets as a percentage of total assets, and we compared that from 2011 to 2012. We're trying to find relationships and trends. Vertical analysis is popular for comparing one company with others or an industry. So you could compare, your current assets compared to total assets versus that of the industry or other companies you're trying to benchmark towards. Then it's an idea we're going to look at called common size financial statements. So here's what's called a common sized income statement. So we find a company, we have the Mooney Company and the Lowell Corporation. They're similar companies, common sized statements, so we can look at the two. So if we're the Mooney Company and the Lowell Corporation is one of our competitors, we could say, well, we can look at the sales percent of net sales. We can look at our gross profit percentage compared to theirs. We're a little bit better, 30.4 versus 30. Our income from operations is only 10.7%, where the income from operations from Lowell Corporation is 14.4%. And we can see from that we have higher operating expenses. Our administrative expenses are a little bit higher. If we look at our income tax expense, we have a lower income tax expense than the Lowell Corporation. That's because our income's lower. And then our net income percentage is 6.1% versus 9% from the Lowell Corporation. So that's what we try to do with common size statements. We go down the line with vertical analysis for each company, and we compare ourselves. If we're Mooney, we're comparing ourselves to Lowell and see where we're better than they are and where they're better than us.